You heard what Marko Kolanovic had to say. Agree with him or disagree?
Yeah, I agree. Obviously, there's 20% downside. That risk exists every day. And finally, I think Marco and I agree that getting some T-bills and chilling is probably a good place to be. But everything's looking pretty washed out in this market, and there's still a very healthy supply of demand in for securities. It seems like there's an insatiable demand now for 90 and 60-day treasuries, and good. That's good news for T-bill and X-bill. But I don't know that the stock market needs to go down 20% to prove out all these theses to be correct. At some point, that's the trade you want to take. Maybe that's not today, but as you start to look at unwinding duration and as you think about what's going to happen in 2024, it seems like there's still a lot of positives for the economy that we will see, and that the financial economy just might be washed out in the metrics, but is still pretty vibrant, and it's going to be a good place to be later in 2024.
All right, T-bill and chill. I haven't heard that one. You might want to drop some merch. That might be popular right now. Steve, I'm going to come over to you. Agree or disagree with Marko Kolanovic, and how does it shape your view of Q4?
Yeah, look, I think certainly higher rates for longer present a risk to the economy. We know that. It leads to higher borrowing rates. But historically, when the Fed pauses, which it looks like they're going to do after probably one more hike in November, stocks have rallied on average, 10 to 15, 20% on average when the Fed has paused. And if you look over the last 40 years, Frank, the S&P 500 hit a record high every time the Fed has paused. And so, look, are conditions for recession starting to accumulate? Yeah, absolutely. But the issue is timing. It could be 6, 9, 12 months away. And I don't think that equity upside is capped at 5 or 10%. It could be a number much higher than that.
Really?
And so, yeah, well, yeah. I mean, look, again, historically, what you've seen when the Fed pauses, particularly if unemployment hasn't picked up, and we've got a report coming today that's almost certainly going to show that it hasn't picked up meaningfully, is you've had S&Ps that have hit all-time highs because the market, whether or not it is right or not, tends to price in a soft landing when the Fed pauses. And
okay,
so, yes, we've
Steve,
had some pressure, but
Steve, I want to ask you, is the bond market pricing in a soft landing? I know you were talking history just a moment ago. You're also looking at some history and some new precedents being set in the bond market, specifically the inversion between the 2 and the 10-year yield. So kind of explain your thesis on this. What's the history that we're seeing, and doesn't that only signal recession risk?
Well, usually yes, but there's a wrinkle here. So when the yield curve inverts, that's usually an early warning sign for recession. And then when it uninverts, when it re-steepens, that's a sign that you're imminent. Slowdown is imminent. But it's never uninverted the way that it's uninverting right now. Usually what happens is that short rates are falling as the market's pricing in cuts. But this time around, long rates are rising. And what that's showing is that the market's either trying to price in higher for longer, or it's renormalizing, or we just have a buyer's strike. And so it's not clear that that signal is what it usually is. This may be a recession signal, this uninversion, or this time around it might be saying, hey, we're recognizing that it's higher for longer, and that nominal GDP is going to be higher. It's a higher inflation, higher growth environment. Unclear.
Yeah, we continue to watch that inversion. So, Alex, back over to you. I know you're T-billing and chilling. Worldwide Exchange becoming a show about bonds recently. So when you're T-billing and chilling, is it the short end or is it the long end?
Well, certainly right now, investors are buying the short end products that we offer, and that's made sense for a long while. But increasingly, we see folks extending duration. As Steve pointed out, this is an uninversion that's necessary, and it needed to happen this way. And it's also a Fed who, as opposed to trying to stimulate an economy, is actually still actively trying to destroy job creation, which is a very strange place for them to be. So as we see the long bonds come out, and there are a lot of folks right now, particularly younger analysts, who are running to their dictionaries, looking up what is a long bond and wondering, can their Excel spreadsheets have interest rates that don't start with a 0 or a 1? This is what it looks like. Long term, the long bond at 5 isn't an absolutely insane number. Even the 10s at a 4 or 5 is not a terribly bad place for us to be.
So wait, when you say both are a pretty good place to be, are you buying the 10 right now, or advising clients to buy the 10, or is it the 30, or maybe even the 20, which we're not showing right now?
The 20 is always an interesting issue, just given how it's occasionally isn't offered by the Treasury Department. So we've always liked the 20, but most of our clients are sitting in 6 months. So and we offer
6 months. Okay, so the short end, basically.
The short end, and we see a lot of interest unwinding into 3s and 5s, but I don't know that I'd want to make that trade yet. As Steve points out, though, you're not terribly penalized for being a few months early on that trade. You don't want to be 6 months, 12 months early, though.
All right, let's talk a little bit about equity. Steve, I'm going to come over to you. Right now, you say you're actually buying because you do think there's more upside in this market. And what you're buying is the Russell 1000 growth. Why is this the right time to put money there?
Yeah, look, you've had rate-sensitive stocks get hit over the last couple of weeks. There's dividend payers on the value side. We've finally started to see some sell-off in kind of large growth names. You buy them for a couple of reasons. One, if you're going to have another move higher here because it's been stretched. The Treasury's kind of really sold off. The equity market stretched to the downside. You could see a little snapback. We think growth benefits because it's gotten hit by these higher rates. But then secondly, if Marco's right over the course of 24 and the economy slows, you want big, strong cash flow generating companies that don't require a lot of external financing. And you're going to find those in the large cap growth space. And so having been underweight for most of the year, we're starting to nibble.